Hey everyone, this is the DNA Money podcast, and we are on episode 6 today.
Yeah, and as always, we usually start from update on the podcast, and it was very funny. Like the last time we were done with the podcast, and we were like collecting the videos and stuff, and then so we get the video from one of the cameras, second one, it's all cool and all, and then we kind of started doing something else um, around the studio, and then and then at some moment we were like, okay, let's Daniel was like, did you get did we clean out the video from like
One of the cameras,
yeah, the
the
main
middle
camera?
camera. Yeah.
And I was like, no, we didn't. Let's do it. And he went in, and we were just talking about something else, and he's
I
like,
just
okay, let's start recording. And he presses
the record button.
the record button. I was like, did you send the video to me? And he was like, no, I thought we already did that. He was like, oh shit. And so what happened was he just completely erased the main video from his camera. So
For the middle camera, which is probably the most important one.
yeah, I mean,
Shit happens, as they say. Again, my apologies, wasn't that on purpose. But yeah, it was definitely funny because yeah, I didn't even think about it. I just went ahead and removed, basically freed up some storage by removing that video. And as it turned out, we haven't transferred it to the laptop or to our main storage. So you guys probably saw the episode with just two cameras really
Yeah.
close up to our faces and didn't see the main picture.
and we were bragging about the lights and the cameras and all that stuff, and how this time it's gonna work, not like the last time where the last the episode number 4, the only camera that worked was the middle. Yeah, actually it was the middle one, and the other
Yeah.
ones didn't. So yeah, I mean,
We're just testing things, you know. We're shooting episodes with the middle camera only, and then with the side
Yeah.
cameras only, and we'll see which one gains more views.
We can spin up that story too, but that's gonna be a lie. Um, yeah. So this episode,
Lesson.
hopefully we will learn our lessons. All of the cameras are gonna be recording. We're not gonna lose the sound either, and everything is gonna be okay.
Yeah.
So
I'd say it would be useful to maybe create a checklist. I mean, we already have a mental checklist, and I think the first lesson we've learned is that you have to check whether you actually hit the record button on all of the cameras, and we do probably like 3 checks before actually starting the
and then
podcast.
somehow still miss it, but
Yeah, and then the point number 2 is don't erase videos completely from your phone unless you made sure you're sure that you've transferred all of the information to your main storage.
yeah, I mean that should be pretty common sense, but I mean it's gonna happen anyway. And yeah, the story is very old. I believe like I've seen a lot of like people, or we didn't record this camera didn't work, and
Yeah, and I think it also happens when it's just you or 2 of you who are running everything, right?
Yeah.
From recording to setting up equipment to editing to posting. It's just a lot of things, and obviously like after hour and a half of not filming, filming, you get tired, and your mind can like slip these things easily.
Yeah, and you gotta also remember when we're setting up these cameras, it also takes some time, like the lights, the cameras, the chairs, and positioning everything. The podcast may be an hour, but setting it, this whole thing up is
Another hour for sure, and then after the podcast we'll also work on either video editing or posting it or writing descriptions, and definitely takes a lot of time, especially when you have like other full-time jobs.
yeah, that's, and I think you should always dedicate most of your effort on the things that bring you results. That might be like, oh, there's potential reward here, but you should still focus on the things that actually give you returns. I made this mistake a lot of times before, like when
What are you referring to exactly? Like with podcasts, you mean?
I'm saying we have our main jobs,
Oh, okay, yeah.
and we should probably focus on those like first, then maybe
Right, right.
yeah, this second. And yeah, because I made this mistake a lot of times that I was like, oh, this seems like a new shiny object and it's gonna bring me all these opportunities and maybe all this money and all that stuff.
Yeah.
And then I started focusing on that and then started losing track with
The
something
other
I have
thing.
already working, running, and that's not good.
Yeah, and I think, look, with I also noticed that like I want to focus or I want to do many different things, or let's say I'm working on one thing, and it seems interesting to me at first, and then I work on it for some time, and then later on I realize, oh man, this gets a little bit boring, and it's normal because whatever you do for, like, if you actually putting a lot of time on it, you just, if you're working too much on one thing, it gets sometimes a little bit boring, especially um, um, if you're focusing more on like operations and like monotonous tasks, right? And then or your brain tries to switch focus on something new, and as you said, you switch your efforts, and then you're not gaining enough of momentum with a new thing. At the same time, you're not completely focused on another thing, and therefore you're just not generating enough of return, I think,
Yeah.
on any of those things. But at the same time, I still think it is important to try new things, especially if you're, young, because finding those two or three, activities that you really love, or like you really, really brings you joy and satisfaction, is important in the long term.
Yeah.
So it's like it's all about the balance between new things and focusing on your main activities.
Yeah, that balance is tough though, and you still should prioritize the things that kind of
Yeah.
work already.
Yeah.
Which is also kind of a slippery slope at the high scale for companies. Like, let's say, some big companies spending all of their money on like newspapers, right, and for advertisement, let's say, and then but the new guys are able to like dedicate and focus on like online marketing, let's say, and they, of course, they're gonna get bigger returns than you if you only prioritize something that works, but still try something new. And
Yeah. Well, I guess here you're referring more to innovation in your primary business or in your primary activity, right?
yeah, but I mean, personal life, same thing, right? So something, I mean, my career works for me for sure, like but I might still try something else and
Yeah.
see if that's gonna work. Same thing with business, I think.
Yeah.
Works the same way.
No, yeah. You definitely have to try new things. And I mean, speaking of, I guess, various activities, and like in previous episodes, we talked about why we are doing this podcast, right, and our motivations and incentives behind this. And I think it's also, we've talked about our personal growth, like the way you can speak and communicate, tell a story, all of that. But at the same time, I think it's like the diversification of your skill set as well, right? Because you can monetize your very skill set, and that hedges you against just what happens randomly in life in different situations.
Yeah, that the skill of talking, you can always monetize it in any industry. Um, Being able to talk to on camera, that's very important too. Being able to discuss complicated topics is a very important skill. And yeah, that's not necessarily like a different skill from what we usually do. It just works along with it, like a symbiose.
Yeah. Yeah. For sure.
Because like on one side we could say, oh, we're like for example, I'm a programmer, and then I start doing music. That might not really help unless I'm like doing programming for like a music production company or something like that. So that would be way different. But learning how to talk, present yourself, present your ideas, that's applicable in any industry.
In industry, yeah. And I think, as again, we've talked about it previously, but by being able to speak well and to articulate your thoughts well, you can basically, well, first of all, explain your vision. And whatever you do, if you're starting out a company, for example, an early stage, what you have to do well is like, well, build your product, but also sell. And by selling, I mean talking to various people, including customers and employees, because when you're hiring new employees, you have to convince them why they should join this company. And it is especially hard to do if you're attracting people from already huge companies. If we're talking about like tech businesses, if you're trying to attract someone from Google or from Facebook, from Meta, you need to convince those people to get from like highly paid positions into an early stage company without the same salary, but with a potentially a greater return through the options and stock options that that the employees will be getting, and things like that.
I cannot imagine like poaching people from Facebook and Google now, Microsoft or those companies. I mean, it has to be also not just monetarily, but you should be convincing them that what you're gonna do with your effort, like company, that's gonna be valuable to society. I think because those people like Facebook employees, Microsoft employees, Google employees, if you look at their stock compensation, not just the base salary. The base salary might be like competitive, but not super crazy. But the options and all that stuff, those people can
a lot.
could. So like an engineer for Microsoft, Facebook, or Google, it might not look like it like at the beginning, but they could be actually making 500,000 a million a year with their stock bonuses and all that stuff.
Right.
Like,
I guess you have to look at the total compensation.
and they can be actually making millions, which is pretty. So I heard this talk. Somebody was talking on those compensation and how the employees are gonna get hurt with the current market condition, because a lot of employees, if you're kind of a high in the food chain, and maybe like maybe you're making like $1 million. I mean, maybe you're making like 500,000, let's say, in base comp, and then you're making 1.5 million in stock comp
a year.
You expect that's your actual income, and then you live off of as if you were making 2 million a year, and then the stock just
crashes
completely, and now you're kind of stuck with like this lifestyle. You maybe bought a house for a huge amount of money, and that's dangerous too. So, but I mean, maybe for some listeners that sounds crazy, like, oh, who makes $1 million a year? But that's pretty common in like tech and stuff, for higher roles, that the stock compensation is going to be significant.
Yeah.
I've seen recently a graph where I think the Carvana, maybe I'm confusing it with Rocket Mortgage. So one of those companies, I think it was Rocket Mortgage.
Okay.
So they have their C-level executives are making something like $700,000 base comp and another $8 million in stock compensation.
Wow.
So that's pretty good money. But the stock of Rocket Mortgage, I think it went down like crazy. So if those people built their lifestyle around making 8 million and now they're making 3, they're in big trouble.
But at the same time, when they're still like living off of their salary, right? And then the stock
Not
compensation,
necessarily.
this is not liquid, right? They have the options, right? Basically, the right to purchase the stock at a particular price
Yeah.
in the future, right? And then they have the vesting schedule, which means that they have to work for a certain amount of years before they can exercise those options.
That
and
is
actually
true. But
buy.
if someone would tell you, okay, in a year this option is gonna go liquid and you're gonna make $8 million, how much money are you gonna spend?
Yeah, and I guess and
You're gonna expect it to be there, right?
right,
Maybe
or
you're
you're
not
not
gonna
gonna
spend.
expect it to fall by 40%, 50% as it
Yeah.
happened in the past month. Um, that's true. But do you know if they're getting like loans against those options?
That could be
I think
also true.
Yeah, I think I'm seeing now more, startups or more companies that kind of operate in the secondary markets where they're offering, they have certain funds, or it's a marketplace where they're offering these employees to buy those stock options for a particular discount of its market value. And then those employees can get liquidity very, very quickly. And therefore, live off that money.
Yeah, and then it dips and
Right. Well, if it dips, then it's not good for investor or whoever purchased those stocks, right? But if you like liquidated it or gave away your rights or sold it
it
to
also
someone
depends
else.
on how the deal is structured too, right? So they could call on them on those stock options, right? So like it's all
It's a different topic, but
yeah.
usually how it works is, yes, you can basically, these funds, they're coming in. And so let's say you're working at Open Door, right? And let's say you have a certain amount of stocks. Like, I can buy them from you, or and offer you liquidity by buying those rights, and it's gonna be like an interest transfer, um, or sorry, a rights transfer, where you give me rights to basically not monetize, but to sell those options in the future, or we sign an agreement that whatever you're selling, you're going to be transferring to me in exchange for a cash payment that I can provide to you at the moment.
Yeah. So
Would you do that?
I mean, I'd buy a boat.
You'd buy a boat, nice.
Nah. So the lesson is don't overspend. I guess it's a simple lesson, but yeah,
Or
if
count
you're
on your salary, don't count on your stock.
expect stock to be there, but don't really rely on it until you have it liquid. And if you do rely on it, maybe like reinvest the liquidity into something else, not just waste the money on the lifestyle, because lifestyle is a dangerous thing and it can creep up on you, and then you realize like, oh, did they just laid off a lot of people, and then I don't have a salary anymore, and I was expected to make like millions this year, and then now I don't make any money this year, and
Yeah,
you're like, oh, I'm spending like $15,000 to survive, basically, to keep the lights on.
for sure. And I think we've drifted away a little bit so we were talking about the speaking skills, right?
Yeah.
And how it is important to be able to sell your vision, because that was an example of starting a new company. But anyways, that's what we're trying to do with our podcast. I think that this is how our whole conversation started. And yes.
Yeah. So today I wanted to talk about the venture capitalism. So Danny, he's in that industry. So I think I would love to learn more about how it works and understand what's the big idea behind it, how they see companies that they invest in, what kind of companies would the venture capitalists usually invest in, and go from there. So um, maybe you could explain us what it is venture capitalism. What do venture capitalists do?
Yeah, absolutely. So I think venture capital. Looking at the name of the industry or of that segment, which is a part of private equity, right? So this is capital that is being invested in private businesses in ventures, right? And venture by the definition is a very high risk business. So venture capital, I think, a brief history is it was born in in the Silicon Valley in the 1960s, I believe, and it started off with semiconductors, and this is what like really propelled the semiconductor industry. The capital that was invested in the first semiconductor companies, and at that time those were considered very, very high risk businesses, and at the same time they were very tech or high tech businesses. It was
I thought it was started from like military or something. Did it not?
Semiconductors?
No, the
Venture
investments
capital?
in venture capital in Silicon Valley. Didn't it come from like military investments?
Well, military investments would probably be considered more of grants at that time, and I don't think it would be investments in particular, because military was looking not for a financial return, but they were looking for a technological return, and they would probably not buy an equity in those companies, but they would invest sponsor the development of the product. And I'm sure those were not, those were probably, capital that was dedicated or given to research institutions as opposed to private companies.
No, I mean the whole Silicon Valley industry. I think that's what I heard that it all came from. But so semiconductors, right? So and then from there,
with and later on, basically the early investors made a lot of money, a very high return on those investments, and more and more kind of investors understood that this is a very lucrative business if it succeeds, right? So again, venture is a high risk business, and the higher the risk, the higher the reward. This is, I guess, the part of the law of finance and investments, and in general. So as of now, venture capital basically is capital that gets invested in high risk businesses, where in return for your investment, you get a particular equity, or a particular share of the company, and that share grows in value with the growth of the company that you invested in. And venture capital usually focuses on, again, high tech businesses. Right now, all of this, the new companies that we see in the newspaper and magazines and news, all of them, or most of them, I should say, are tech related, right? And most of those companies are not bootstrapped necessarily. They're venture backed, meaning that VC firms or venture capital firms, they invested in those companies. And I think VC is really, really important in our economy nowadays, because I don't have the exact statistics, but I'm sure we can put it under the video. But it is responsible for a lot of, first of all, generation of jobs, right? Because by investing in this new companies, you create jobs. Second of all, in general, like the value that those companies provide to society is huge, and if we look at these companies such as Google, Facebook, YouTube, Amazon, like all those tech giants, they were venture backed. So this is a really important industry. Now, I guess point number one, VC is basically capital that gets invested in high risk businesses, and usually those are tech companies. Now, the goal of VC is to generate a financial return, basically to make money. How it works statistically, this is the riskiest asset class out there. If we look at so public markets or public equity would be one of the asset class. Real estate would be a part of alternative assets, right? And real estate is quite safe compared to others. Now, private equity is when you are buying out businesses, but usually those are traditional businesses. VC invests in early stage is, I think, point number two that I have to make, and on a stage where you might have just an idea of starting a business, or you may already have a sort of a product or a service that you're developing.
Yeah, but I think that's also changing, right? So with this series A, B, C, D, E, F, G, whatever we are getting into, right now some venture companies are not really venture anymore, right? So they would invest into high growth opportunities, just not into early stages. So I think that's why this cycle got into venture capital so fast, because the reason why stock market fall down affected the venture capital
private markets.
Private markets as soon as it did, is because right now really the series D, E, F companies, and those are the huge VC capital firms are mostly investing in. Those are not really like ventures anymore. Those are like established companies that they're kind of pre-IPO companies. And
well, I mean, I guess there is a big distinction to make. Is there is a early stage investing, VC investing, and there is a late stage investing. Usually, late stage would be referred after to a company for companies at the stage of post Series B, and I think it's important to maybe. Yeah, I'll give a brief explanation of this stages and the series of financings. So I guess as industry grew, the investors and founders started recognizing certain patterns, right? And then as the industry matured, it has become more structured. And so overall, there are several ballpark rules on how this investing works. So at a very, very early stage, when your business is still at ideation stage or pre-product stage, investors invest in a pre-seed round. So pre-seed basically means before you planted a seed and before your venture or company started growing. So that's the first round. Then after you play with that money, you invest in, and you increase your team, you start building out product, you can raise a seed financing round. And usually the frequency is, or the timing between those two rounds is 12 to 18 months. So within seed round, you start working on the development of the product, or you continue working on the product, and you start a product market fit discovery. Product market fit, and I think that's something that we briefly covered in our last episode, is when your product just you find your target market, and it clicks between your product and between the target market. It's basically it's hard to define it precisely, but how I understand it, or how it's usually being perceived, is when customers just like start. There is a lot of demand starting to generate for the product or for your service, and it's just almost seems like it sells itself, the product. And then after that, you get to a Series A stage. So once you've discovered that product market fit, ideally you get to Series A. Series A is where you raise a lot more money. Usually, I want to talk about ranges, but the ranges are huge, right? Especially because there was so much capital in the past 2 years. And yeah.
But it's important to understand that at each of those stages, pre-seed, seed, Series A, the founder gives up equity. The equity is like the shares in the company. So the founder you might start a company with 100%. And whenever you take in money, you generally, I'd say, you give away 20%. Somewhere around 20%. And so that's how you find out that, okay, Jeff Bezos, he's maybe worth upwards of like $200 billion, but he actually only owns like maybe 8% of Amazon.
Yeah.
And some percentage of other companies that he owns. So
I think a good like data point to mention here is, I think by the exit of the company, and that's basically when the company either gets acquired by another company or it gets listed on any exchange. The founder usually has, I think, around 15% on average by the exit.
Yeah. So you might be surprised by that stat, because those people have so much wealth, like crazy amounts, like $200 billion. But in the process of making this $200 billion, which sounds crazy even to say like that amount, that's the person could have that much control. But in the process of making this much money, they also generated like $2 trillion for other people. And that's not counting salaries that they paid out. That's not counting
just in
like,
stock value.
Like money to their like suppliers, the amount of value that they generated to their customers. And so building a business, even if you are getting super rich, you hear about those billionaires, they probably like made so much more people even so much richer.
Yeah, and I think you mentioned Bezos, and I think in one of his speeches he was saying how and again, I don't remember exactly how much of Amazon he owns, but if he owns only 8%, right, it means like 92% of those owners, they grew their wealth as well. And those, of course, most of those are institutions, but even those 401k accounts that invest in various companies, they invest in Amazon. And then and I don't want to get into like wealth distribution topic, because it is quite complicated and arguable, but this is how wealth allocation works. And it grew not only for Bezos, but as you said, all of the stakeholders, really, and especially shareholders
and people's pensions and everything. So everybody gets paid from it, and they also pay their employees pretty generously. So, I mean, not every billionaire, millionaire, whatever, pays everybody fair and all that stuff. But in general, they were able to build something that provided a lot of value, and that's why they're rich. But coming back to venture capital, and so there is pre-seed, seed, Series A. That would be considered early stage. Series B
Series B is usually already considered late stage.
Late stage.
So yeah, Series B and I guess Series B and post Series B is late stage, and you met that point where like those are not really ventures anymore.
Series B might still be a venture. I feel like.
Yes, and I think it depends on. It really depends on how big the company is and how sustainable it is, right? And again, a really hot topic now is revenue growth versus becoming profitable or generating profits, because a lot of these tech companies, what they realized in the past 10 years, that they could raise a lot of money. So the capital, the cost of capital was quite low, meaning that it was quite easy to attract capital into into their company, and therefore they could boost their growth by acquiring more customers, by maybe selling their products for a cheaper price than it would have been otherwise to make profits. And so again, it could be arguable, like, can they survive without venture money, even these big companies, or without a capital injection?
Yeah,
that's under question too.
Yeah, and there's been a wave of SPACs too, which is kind of a middle stage kind of a company trying to figure things out, but they're going public. And and
for specs, I think it's worth mentioning or worth explaining what it stands for. So spec is basically special purpose acquisition company, and not to get too much into detail, the purpose is to take company public, and the thing is, it's just way cheaper, easier, and faster to do it through a SPAC mechanism rather than through a traditional initial public offering or IPO.
Yeah. So let's say somebody starts a business. So how okay, let's come from your perspective. So let's say you are what's your day to day in venture capital? What do you do?
And I would say I guess touch on like what my goals are and objectives are as a representative of a VC firm. So for us, our obligation is to generate return for our investors. So like how it works, the structure of the venture capital fund is basically before investing the money, you have to take it somewhere first. And it could be either your funds, your personal funds, if you're wealthy and have capital to invest, or the alternative route is to attract those funds from third parties, right, or from someone else, basically. And so the first step is to raise those funds, and we are raising capital from high net worth individuals, from family offices, from financial institutions, and others. But those are our main investors. And once we've raised the fund, then we start looking at ventures and business that we can invest in.
And a fund is basically just a pile of money.
Yeah, it's basically a pool of money that I think some people think that.
So the way it looks is pretty much that they set up a big bucket. Everybody comes in, throws money in, and there's a big pile.
Yeah. So many people think that the money gets transferred to us right away, but in reality, we don't get any like upfront investments. We get a drawback of a certain percentage, drawdown. Sorry, not drawback. But we call capital. Right. So let's say I come to you and I tell you, hey, Alex, I can make you way more money through venture investing. And you're like,
without promising any returns.
Can't guarantee, but I'll try. Yeah. And you're like, okay, I can invest $1 million in you. I'm not going to take $1 million right away from you.
Yeah.
I'm going to tell you my investment strategy. So let's say I'm going to invest it over the next 4 years. And then, I'll tell you that I'll call capital when I have an investment and when an investment to be made, and I can do it either like on a fixed schedule, let's say every quarter or every half a year, or I can do it like on demand. Different VCs have different strategies. So basically, you're not going to give me your $1 million right away because it's going to be too high of a opportunity cost for you, because you'd rather invest it in somewhere else and make money somewhere else, right?
Invest in a podcast, maybe.
Exactly. But whenever I call capital, then you transfer money, and then I transfer it immediately to the startup. Startups are basically companies that we're
And they start to burn it, just set it on fire.
Set it on fire with a goal of growing their company and raising more capital in the future.
Sounds nice. Yeah. And so that would be like the general description. So you would take the money from somebody, you try to find the startup. So what's the process of finding the startups that you're gonna invest in?
Yeah, so for different funds, the first of all, like, you have to identify your focus, and usually those are defined within the investment stage, and also within the vertical or industries perspective. So it could be, let's say our fund is focused more on deep technologies, and deep tech, again, to provide a brief description, is basically technologies that are have like a very complex engineering component involved, or have put in a lot of R&D efforts into them. And so this would include robotics, this would include, advanced materials, additive manufacturing, IoT, maybe some AI and ML technology as well. So complicated stuff in short term. And once you have that focus defined, you have to identify the stage. We invest in early stage, so it's pre-seed to Series A. After you're done that, you have to start finding those investments and or find those interesting opportunities, investment opportunities. And honestly, so this is where the whole, I guess, this is why investors give you money or invest in you, because you should have access to what we call deal flow, right? To different deals, to different investment opportunities. And you do it through your personal network. So usually...
so just in case somebody would be wondering, well, why don't those people who have millions of dollars just invest into companies themselves? Because it's hard for those people to come across opportunities unless they're like dedicated to looking for them.
Yeah,
and so that's what the actual like benefit to society that the venture capitalists provide is that they actually spend all their time and effort into generating deals and finding like startups, industries and opportunities that they deem interesting and profitable.
Exactly. Because, specializing in something, especially in a really high risk asset class, obviously requires a lot of time and a lot of effort, and you have to be like in that, you have to be like part of that party, or part of that circle of entrepreneurs, of other investors. You have to be constantly looking at new things, and if you're a general like investor, or as you said, like a high net worth individual, and you're running your own business, you just won't have enough time to find those opportunities yourself. So that's why you find a specialist or an expert who can do it for you. And I think it's worth providing some statistics. So out of usually how it works for VC funds, out of 10 investments that they make, 3 will fail completely, because those early stage companies are, again, super risky, and anything could happen. Like, there's just so many risks that it's hard to list them all. And so 3 will fail completely. 3 will probably return you the same money that you invested in those companies. 3 will probably generate you somewhere between 3x to 6x, so like 300% to like 600% of the money invested. And your the one investment that you made will return you, like 30x or 100x of what you've invested. So it's really definitely not a what do you call it? A normal distribution here.
Yeah.
So we are looking at that one deal, one startup, one company that can return our whole fund and beyond, and can generate all this money.
Yeah.
So that's the statistics, and that's why it's really like you have to be full time looking at those opportunities, because most of your investments will
Yeah.
fail.
Can you try to explain on how do venture capital firms actually make money? So you take money from the investors, you give it to startups and founders, but where's the money
Yeah.
coming from to you?
Yeah, so I guess the salary and operations expenses get covered by a so-called management fee. Management fees are usually, let's say, 2% is
A
the
year.
industry standard a year. So let's say if you raised a $100 million fund, you're getting $2 million yearly out of that fund. And those go to, again, to cover operational expenses, including your salary, office rent, certain events that you make, software, like whatever you need to perform to do your work. And while 2 million, sounds pretty lucrative, especially if it's run by a lean team. By lean, I mean, there are VC firms that are only like 5 people or even like 2 people sometimes. But the real money, where the real money is made, is in so-called carried interest. So carried interest is what VCs or venture capitalists take from the profits that they generate. And usually it's 20% carried interest that is being charged to investors. So let's say I've raised a $100 million fund. Over 4 years, I invested that money, and then by the end of the lifespan or lifetime of the fund, which is usually 10 years, I've generated 300 million. That means that my pure profits are 200 million. And I can take, or I will take 20% of the profit, which means $40 million. And so that's where the real money is getting made.
Yeah, that's interesting. But that's assuming that those companies can go liquid. So they are either acquired or they go public.
They go public,
Or you share, or you sell shares on secondary.
Well, the thing is, if the lifetime of the fund is 10 years, like you have to liquidate those investments. And those can be, either through, as you said, either through acquisitions. So let's say Google acquires one of the startups that were that were out there. Then the company goes public, and then we can liquidate shares in the public markets. Or we can liquidate it through secondary markets. By secondary markets, I mean we can sell our shares in a particular company to another
some other
investor.
fund.
Yeah, other fund or individual or
whoever
wants
to buy it.
Exactly.
Cool. Yeah, and so I guess part of this being a venture capitalist is networking, for sure. So you have to have a strong network to perform, to be able to see the opportunities before everybody else sees them. And so maybe tell us about your experience with networking. It has to have been harder last 2 years than it usually was. Was it?
It is. Yeah, it's a good point. It became harder, but easier at the same time. So, but yeah, I guess speaking of the networking first, it is a probably the most important factor in this industry, because how you find those investment opportunities is not through like a Bloomberg terminal by looking at the companies in the particular industry, because those startups, they're not listed, or not all of them are listed on those websites. I mean, they could be on Crunchbase, which is like a crowdsourced
but that's
platform for
later stage, because by the time they get there.
No, I mean you can find them, like there's a bunch of pre-seed
Mhm.
companies as well and seed, but yeah, I mean usually you're right. If it's already on Crunchbase, you might have been too late already. So how it works usually is you find those opportunities either from startup accelerators. So there are these programs, acceleration programs that recruit or that get entrepreneurs to go through the program, where mentors of those programs, they teach how to build a company, how to reach your objectives, financial objectives, and then operational objectives, and basically how to become a huge company. Now those startup accelerators usually recruit or get really early stage companies, and they have so-called like pitch days. So after you graduate from a startup accelerator, as a startup, you would the startup accelerator would connect you with their network of investors, and usually usually investors just visit those pitch days themselves as well, because again they want to see different startups and different investment opportunities, and usually after graduating from such programs, these ventures, they are, or the founders are way more equipped with knowledge of like how to raise money, how to run a company. And basically because they get coached by mentors in those programs, they can make less mistakes. So the risks is somewhat mitigated, or is more mitigated for investors. So that's why like this is one of the good sources to look for companies. Another source would be just honestly through your personal network, right? So we invest a lot in space technologies, and because we've already invested in certain companies, those founders, they have their inner circle of like other founders, and whenever they see something interesting and worthy, and they think this could become huge, they would connect or refer that startup or that founder to us, to investors. So this is also a great source of high quality investment opportunities. The third would be other investors. You talk to other investors. Other investors tell you some interesting companies that they spoke with. You tell them about interesting companies that you spoke with, and then you share. We call it sharing deal flow. So you're sharing deals, and eventually you can get connected to some really interesting opportunities that fit within your investment profile and fit within your investment strategy, and you make an investment. So other VC firms. And fourth is probably it's just going and visiting, attending those events. And events are organized by different parties, including startup accelerators and other VC funds, or just in general, just there's a lot of organizers of these events. So you go there, you talk to people, and then you can find something interesting there as well.
Yeah, that's very interesting how it all works out. And then so whenever you meet a founder, what's the first thing you're looking for?
I guess the first thing you look at is whether it fits your investment profile. So if we're in early stage, right, is the founder raising a pre-seed, a seed, or an A round, or they're raising a B, C, D, and so on. So if it's out of our stage of investment, then we're not gonna, like, it's not worth looking further, because we just won't be able to provide enough capital for them. They're probably raising a bigger amount if it's a late stage round. Second thing is what industry they operated, or it'd be on par with the first one, right? If it's within our investment thesis, then yes, we would go deeper and look further. If not, then we'll pass on it. For example, if you're coming to me and you're developing like a personal finance app, right? I would, since it's not in particular deep technology, it's more of a consumer software application, it doesn't fit within our thesis well, then it's probably like not going to work out.
Yeah.
So that's why you have to look at the industries and verticals that a founder operates in. And after that, um, if there is if a founder develops something interesting that fits within your profile, you start doing a diligence. Now the diligence includes several things, and the first one would be focusing on what problem the founder or a founder is solving, because it could be the problem could not be real, let's say, or
Yeah.
it could be real. Now we have to make sure that the problem is real. So you look at the solution as well, right? After that, what is the solution? Have they built it or not, right? By solution, I mean a product or service.
Can they build it?
Can they build it? Yeah. Well, can they build it? It's part of the team. So yeah, we look at team as, and a lot of VCs, probably all of them will tell you that the most important factor for when considering making an investment is the team, because there's just so many risks that are not even identifiable at an early stage, that only betting on right people who can mitigate those risks and who can go through those obstacles can hedge you against those risks. So yeah, the team is really, really important. And then market size. So market size is how big
is the opportunity.
Is the opportunity, basically. How many people can this company serve? And therefore, how much money they can make in the midterm and in the long term as well. So usually it's market size, it's team, and its product is what we pay a lot of attention to.
Yeah. Anything? Any crazy stories from there?
With
I don't know,
doing
like,
diligence, or in regards to
like
I guess with
crazy people coming in like, oh, I'm building. What's the
so
the craziest thing right now? Let's say, what's the hype
NFT.
around NFTs, NFT startups?
And we don't target those, but yeah. So for example, I recently went to this event here in LA, and they had a really interesting program here and a program there, and really interesting agenda, and it was like one of the first big events after the whole COVID thing. So finally the ecosystem starts getting back to normal, and we can attend those in-person events. But honestly, I kind of forgot what it even feels like at those events, because yes, there are some great companies in those events, but also there is a lot of entrepreneurs that are starting something that may seem great to them, but not in particular great to the rest of the society.
Yeah, I've been there, done that.
Yeah.
I wouldn't say it's it could get better than I started it, the way it ended, but yeah, sometimes as a founder you like run too deep into an issue, and you like start seeing clues that aren't there, and like yeah, it's
like
hard
focus
to
too much on something that
on the product, that you forget that you actually have to sell it and market it, and
and you don't get drifted away, and maybe not seeing it from like an objective standpoint of view. For example, I there's a bunch of crazy ideas. I probably in that event that I attended, there was this crazy idea that I probably don't want to talk about. But sometimes it seems so. It just seems like not comprehensible in terms of why this idea would even come to your mind, because it doesn't make sense, or because
why would you
it's
think
not gonna
that's a
generate
good
money.
idea?
And like why do you think it's a good idea, and why are you pouring so much of your personal money and I mean, I hope those ideas like work out, right? And it'd be amazing, but unfortunately some of those ideas just like seem not very reasonable, let's say. But to provide you an example of a more of deep tech play, we got pitched. I remember we got pitched an idea where a founder was developing a technology that could get us from Earth to Mars in like 2 hours. and it was
Sounds promising. Continue.
yeah. Again, if he achieves this goal, it'll
Mhm.
be you get a Nobel Prize. First of all, for sure. Second of
Couple
all,
of them.
a couple of them at least. Second of all, it'll be profound innovation for the whole humanity. But honestly, yeah, there are some people what we call they could be geniuses. They could be just
Mhm.
crazy people that
Yeah.
are pitching some crazy ideas. But investing in deep tech sometimes may seem like you're on a brink of sci-fi
Mhm.
and like actual technology or
Yeah.
actual possible and realistic technology. So that's why I don't have a technical background, but we do have a set of advisors that help us with vetting those and conducting a technical due diligence and basically
Mhm.
saying, yes, this is real. Yes, this is, or no, this is not real, or this could be real if
Yeah.
this and this happens. So
Yeah, but I'm not gonna ask. I guess what was the idea of getting to Mars and to Mars? Maybe it works out. Who knows?
yeah,
Hopefully.
it involves some dark matter.
Cool. Dark
and
magic too.
dark matter engine.
Yeah, that's okay. Maybe one day, but I don't know if.
No, look, I think it could be possible.
Mm-hmm.
It could be a matter of a time, Timing
Mm.
is also really important when you
Yeah.
invest in those companies, right? So if you invest too early, like you have to be right on the idea and you have to be right on the timing.
Mhm.
Because if you're not, then the idea may work out, but it may work out 20 years later than you thought. And there were various companies that appeared in before the dot-com bubble, right? In the 90s, and those ideas were really interesting, and some of them are being realized now, but they weren't successful back then because the environment was not set up yet, or the
Yeah.
right ecosystem was not set up yet. So yeah, timing is important.
Yeah. Cool.
Have you tried raising your? So I know you're
Mhm.
developing your personal finance app, and you've started a couple of apps before that.
Yeah.
What I guess I'm just curious to know what was your experience like with raising funds, if you
I
have done that.
haven't ever really committed to raising funds. Most of the startups that I'm starting, and even this one that I'm doing, I think I'm more in line with the idea of bootstrapping it. It's not a deep tech or anything that would. So it is a proven industry, I feel like.
Right.
And I think I should probably bootstrap it first because getting. How should I frame it? So for me, I think I should be able to validate the idea without any external money, and maybe this podcast could help to do that. And so the idea of my app is to get people to understand their finance and understand. Um, so the general idea is to help you budget and give you guidance. So what most of the finance apps do, they only help you budget things, and yeah, that's good to do, but unless you're being guided through the process, either by a community, maybe like I could add a community component
Right.
to the application where as I discussed in the previous episode, where the people that are one step or two steps ahead of you can kind of guide you to like being where they are maybe, and they could be guided by the people that are two steps ahead of them. Maybe that's the idea, or there could be just a pretty general framework on how you should handle your finance, and that puts you in check every time. So whatever the personal finance tool you use right now, it probably just you probably just record your transactions and categorize them, and then you are to figure out, or like, okay, so this should be my budget here, this should be my budget here, this is how much money I should probably save. But I mean, as if you're a beginner in that and you never made like good money or seen any benefit in saving and investing your money, you're probably not gonna know what to do, really. Like, okay, how much should I save? Like 10%, 20%?
Yeah.
Should I save it all at this point? What should I put my money into? Like, I'm not saying like what stock should I pick. That's not the point. The point is like, should I like save money, or should I like all of my money, or should I put half of it into education, or maybe I should only dedicate, like, see that the people around me, like, that are in the same category, let's say as me, the same tax bracket, let's say
How they are spending it,
how
right?
they are spending money. Or okay, I'm out of line with my food consumption, let's say.
Yeah.
Like maybe I'm spending $1,000 a month on food, and where people who are 2 steps ahead of me, they only save like 500, right? So you'd get a clue that maybe I'm doing something wrong here. Maybe I should kind of restructure that, think about this, because okay, I'm spending 1,000 on food a month, let's say, right? And I'm looking at it, okay, I guess that's how much food costs, right? But other people, the people that are able to progress through certain framework, might be able to spend 500 on food. And then you see that the pattern that, okay, the people who are kind of making it in life, they're kind of spending less here, more here. Let's say they're spending on education more. And there are like statistics about that, government statistics. They're super generalized. Like, oh, the economy spends this much on education, $500 billion industry, whatever. I mean, doesn't benefit.
And they're also providing the statistics just on like an average, right?
Yeah.
Or like some median or mean numbers, and you want to talk, or you want to see more like customized statistics, right? To your particular case. And I guess as like for me, you know, when I'm talking about personal finance or thinking about it, even when I was getting my first car, I was like thinking, okay, how if I'm getting it on lease or I'm gonna finance it, what percentage of my income should go toward a car? You know, what the average one is? It too much? Is it too low? So, and I think I don't own a house yet, right? But I'm sure, like I don't have that knowledge. Like how much should I spend on a house in the future if I'm looking to buy it? And those are important things, because those are probably two biggest, like car and house
the biggest
expenses. Yes.
Yeah, and it also gonna depend on where you are at. So if you're making $100 million, it's probably unreasonable for you to spend on your house anywhere more than like 5% of your income, right? So, but for somebody who's making like minimum wage or like median salary, for them it's going to be pretty reasonable to spend like maybe like even 40-50% of their income on like housing. And so that's where I think my apps, if I'm able to implement it in the way I described, the opportunity is gonna lie into defining some framework that can help people of certain stages progress through those, like from one bracket to another.
Right.
So,
but you're looking to bootstrap it.
I'm looking to bootstrap it first. Get it to. I'm looking to understand that I'm capable of delivering this idea by maybe hiring somebody, or maybe doing it like myself and outsourcing maybe marketing and other stuff. And maybe after that, I'm going to pursue financing. But I don't really see I'm not in a hurry, let's say, on because and I don't really need that much R&D. I mean, I need a lot of R&D, but I don't really need a lot of R&D into, oh, is this like possible or not, let's say. So up to a certain point, I'm going to bootstrap it, get some traction, and then I'm gonna see if I can finance it. Maybe
Yeah.
I'm just gonna be good with like
Yeah.
maybe the audience of this podcast is gonna be like the users, and I'm gonna be good with that, and we're gonna develop it together, and maybe
And I think, this is, I mean, depending on how quickly you want to
Yeah.
move, right? You have to pick your own strategy. But I think, um, once you have some traction, right? Or when you come to an investor and you tell them, hey, I've done this and that, I've done, customer discovery, I've talked to like several thousand people or, 1,000 people, got this feedback. I have, beta users that are happy and I have some traction, and I was able to do that, be very capital efficient by only, throwing or spending so much, this and this amount of money of my personal funds to this. It's going to be easier to raise capital.
yeah,
For
probably
sure.
at better conditions too.
Yeah, and you have way better chances, especially in current conditions. It is hard to, go and just now raise money from VCs by not having anything or just having an idea. Again, because the markets are not performing now and everyone is investors are being now more hesitant. So I think bootstrapping is always makes investors to respect founders more, especially if they're like first-time founders, right? Because if you're still entrepreneurial, sold a company before, you can raise it like that.
Yeah,
you don't need any validation. You should have validation already.
you should probably have a team too.
You usually have a team.
I don't really have a team yet, so
yeah. So yeah, but I think it is a matter of how quickly you want to move.
yeah, I'm not looking to move super quick yet. I don't know, for better or for worse, but I'm avoiding that strategy of like, okay, let's throw everything behind it, and this time I'm gonna take it slow, I think.
Yeah. And sometimes, honestly, again, depending on where you want to get with businesses, and I'm sure like you would agree on this with me, and we say to founders, like, not every founder needs venture capital.
Yeah.
Because venture capital is really bet on those like moonshots, something that will become, like at least $1 billion or like a multi-billion-dollar company. And sometimes founders just want to, they would be completely okay by not growing to like $1 billion, but by starting their business, making it profitable, collecting profits, and like growing, maybe not like very rapidly, but sustainably over years.
Yeah.
And still get to like a really nice position.
And maybe if this app, let's say, it starts picking up traction and organically grows, and then I discover some opportunity that's more of a deeper tech, or maybe like higher scale opportunity, or some maybe like I decide to go, okay, I have these users, I'm gonna go into banking or mortgages or some high something that requires a lot of investments and all that stuff. So I'll be like, okay, we are going there, we are raising this much money, and this is going to be a different discussion.
Yeah. And so you just said that, and kind of makes me think about when you're raising money, you need to have those milestones or objectives that you want to hit in the next 12 to 18 months. And if you're coming to an investor and saying like, oh, I think I need $2 million, but could be one, could be three,
yeah,
it's not gonna work out. You have to know exactly how much money you're gonna spend on the team, on this, on that, to achieve quantifiable milestones and objectives, because this is really important, and this will be used to track your performance, and this will affect your later on your ability to raise your next round, or again your ability to grow the business. So you definitely need to have that, like the spending budget and 2 or 3 scenarios of that budget and of how your company gonna go.
Yeah. Hopefully it happens. And right now it's in a development stage. It's very early. I've been spending time like building authentication screens and stuff like that. So it's very, very early. But pretty soon, I think I'm gonna start getting some traction. Maybe we'll share more details here on how it goes, and what you guys can achieve with that. And I'm even intending to like launch it, like in a limited sense of word, launch, to like the audience, and without like any advanced features, and we can grow it together. And I think
Yeah, I think a lot of and again, I don't work with or we don't really invest in like software companies. We usually do hardware, which is a completely different beast. But we but for some of our consumer hardware companies, how they do it is, let's say they may sell it on Kickstarter, and then those would be like the first either alpha users or beta users. And then they even create either like a Discord channel with them, or sales or a Slack channel, and they just get like a constant feedback from users, and then you support those users support you. You support them by fixing the bugs, providing updated product, and So I guess overall, I think this community driven feedback or development is really important, and I think nowadays it's something that is being super valuable and helpful.
Yeah. So hopefully people are interested in that, and we can all come together and provide like guidelines to people. So the goal with that is to make more people financially sustainable, financially free, literate, and to spread good financial habits like budgeting, investing in something that's gonna bring you returns. I'm not saying like investing in stocks. I'm saying investing in learning, investing in businesses, investing in maybe some business travel or events, stuff that's possibly can generate returns for you. Not stock market and all that stuff. That's
could be cool to, I mean, you started talking more about investing in education, because this is something that probably like hard to quantify, what like in terms of what you're looking to get out of it. But if you try to quantify, it could be really interesting, because I don't think I've seen like any apps or any companies doing that. But for example, like if you're looking to learn a new skill, right? Because education is basically it's all about acquiring new skill set that you can monetize in the future. Maybe if you if you can, in that app, if you could add or sort out different highly paid skills and how you can monetize them, how much you need to invest to get those skills. It could be an interesting idea.
It could be. That could also generate like a flow of money with those companies like Udemy or something. Trying to sponsor that. Partner up and provide some data on skills, and maybe we'll have our users tell us their occupations and their skills, and we will be able to see how much money they are bringing in for certain skill, and then share that, not personal data of course, but that generalized data of, okay, our users, some of them are in this industry, they generally make this, the skills are this, and we can kind of do some data science magic and figure out like what to suggest to certain people and what skills and what they use around those surveys, and could come. We could build a great framework on improving your personal finances to a certain point. Of course, to run into extremes and become super wealthy and rich and Lambos and all that.
I love how you described it. Reach and Lambos.
I don't know, like Lambos, Beverly Hills houses, whatever. That's probably not realistic to quantify because that takes some other kind of some other
skill set or strategy.
I wouldn't say skills or strategy.
Mindset.
That takes mindset, but also a good place, a good time, right approach, like business. So there is certain discussion to be had around nurture and nature of business billionaires and stuff like that. So not everything you can curate, but you could curate. I believe my belief is that pretty much everybody can make $1 million a year if they dedicate their to dedicate themselves to learning and improving and networking. I think it's reasonable.
If everyone makes $1 million per year,
I mean, I'm not saying that everybody is going to make $1 million a year, but there is a potential. I don't know how to explain to people how to make $100 million a year. That's crazy. But $1 million, I think we could come up with a framework for people to get to that point. Now, I mean, that could be a marketing pitch. We'll get you to $1 million.
If you're talking like not gaining like $1 million in savings, but actually generating this income in a year, this could be really, really interesting.
Savings, I mean, government's gonna take most of it anyway, so
at least half.
At least half. If you live in California or something, New York, crazy.
Yeah, cool. No, I think it'd be really interesting to like track, your journey and to show your progress and improvements that you make along the way, and
to track the communities.
And our listeners, if we have any entrepreneurs or founders in our audience, definitely would be great to track their progress, maybe talk about some of their projects even. I'm happy to provide my more of a like an investor's perspective. I guess you can provide your founder's perspective on things, so could be a definitely an interesting synergy here.
And I was more talking like if we build this app and let's say we have a community that maybe we can track like the community of this podcast on the app, so maybe they can join the community, whatever. I'm running into
I see what you're saying. Maybe
and
like
then
creating a group.
And then we could
generate
like a general report or the like average income of the listeners of this podcast went up 20% this year, and they're spending generally on this and this, and we could kind of talk to them on, okay, you guys spend this much money on travel, like why do you do that, or you guys all live in this area or this area. I mean, we could come up with a lot of interesting insights. No,
I haven't thought about it that way, but could be cool. And I think for like any following of any either like podcast hosts or I don't know, whoever's talking about like businesses, or it could be funny to follow the How to Get Rich Quick podcast and like their following and whether those people are
maybe they're exploding. Who knows?
Who knows? Yeah.
Like everybody's making millions next day passively, or whatever the commercials are. But we'll focus on more of a tangible like growth of making real money
for sure
for people.
Cool. But I guess to recap, right? VC, what venture capital is basically capital that gets invested into high risk businesses. Usually during the early stage, could be on late stage as well, but usually early stage. The purpose of investing is obviously generating financial return, and the returns are usually not distributed normally, right? Again, one out of those 10 businesses generates is gonna generate the most of the income. Sorry guys, I'm moving in my chair and making weird stuff in here. But yeah, and the financing stuff, Alex kind of stuff. Sorry about that. But yeah, and pre-seed. Sorry, the stages of investments are usually vary from pre-seed to Series A, which is early stage, and then Series B and post is mostly the growth stage. Yeah, those are two main points. And VCs invest in tech businesses usually or mostly.
Yeah, cool. Maybe next time we'll talk about on how to get started in coding and what the jobs are there, and what can you make there, and what's the approach on becoming a software engineer, and we'll see if that's interesting.
Yeah, no, yes, because it is a very highly paid skill.
It is a great career to start right now, and it's been that for like the last 20 years. It's there's always in demand, and yeah,
cool.
So thank you guys for watching. We expect you to subscribe, share, follow, comment, like,
feedback,
do everything you can to spread the knowledge, and join the community, and let's build together.
Cool. Thanks everyone.
Thanks,
Alex.